Americans living in New York City, San Francisco, and Honolulu all need to earn in excess of $300,000 per year just to have the purchasing power of $100,000 as persistent inflation continues to drive up the cost of living, according to a new report. Things are only getting worse, folks. Americans need to earn a significantly higher salary just to enjoy the full value that $100,000 in financial technology company Smart Asset found in a study that analyzed how much six-figure salaries compared to the cost of living in 76 of the largest United States cities. Now, this particular study actually found that New York, San Francisco, and Honolulu have a cost of living that is well over 80% above the national average. Residents of these cities would have to earn over $300,000 to actually feel like they're making $100,000 in annual income just because it's so freaking expensive. It's crazy, right? So Honolulu topped the list, requiring an income of $312,400 pre-tax, folks. Pre-tax, right? So even if you're shopping at Walmart, Target, Costco, you're trying to save money, ain't gonna work out. You need to make a minimum of $300,000 to live decently comfortable in these cities. New York came in at a very close second with $312,000 needed, while San Francisco required $310,700. So if you guys are thinking about living in these cities, if you live in these cities, that's the math. That is the math, folks. So meanwhile, you know, at the other end of the spectrum, you got Memphis, Tennessee, you got El Paso, you've got Oklahoma, all these different cities with cost of living below the national average had the lowest earnings needed to have $100,000 of purchasing power. Now in Memphis, we're talking about Memphis, Tennessee, where the cost of living is just 13.8% below the national average, you'd actually need $117,000 in El Paso. So in El Paso, you would need $119,000, will actually get you the cost of living of 12.3% below average. Now, very similarly, in Oklahoma, a $120,000 salary would basically suffice. So over half of Americans on high income salaries above $100,000 are living paycheck to paycheck in December as inflation continues to outstrip wage growth. This is based on a survey that came out recently in January. So the same high income earners were struggling to just keep up with monthly bills. And since hitting the peak of just 9% in January, inflation in the United States has dropped steadily, but remains unbelievably elevated. Now in March, the rate of consumer price inflation was 5%, remaining significantly higher and above average compared to the last 30 years. So folks, side hustles, small businesses, home-based businesses, it's almost a requirement at this point. And in a very similar survey by Smart Asset, New York ranked among the highest of the cost of living. And it said that the cost of living compared to a $100,000 salary with the six-figure sum feeling more like $36,000. So what they're saying is that in New York, if you only make $100,000 a year in New York, it feels, just because it's so expensive, it feels like you're only making $36,000 a year. So it's almost like, it's just unbelievable to think that. Boston and Los Angeles follow very closely behind the $100,000, equating to $46,000 and $45,000 respectively. Now, the high cost of living in New York stems from the inflated rental prices and the wages that are struggling to keep up. Rent prices are up 13% in August of 2022 compared to previous years, while the wages dropped 9% according to data from Easy Street. Now, the real question is, where do you invest your money during a recession? Now, I want to talk to you guys about that one. So I would say that the best, or at least three of the best ETFs to buy in a recession in 2023, at least according to some recent financial experts and analysts, economists, let's just go ahead and break some of these down for you guys, because a lot of you guys are saying, hey, how do I make money in 2023? How do I protect my wealth? how do I actually create passive income and compound my money financially during a recession, right? And recession fears are swirling, and we know that, right? And so this means that investors are worried about a bear market or a stock market collapse. And let's just talk about, the three sectors that tend to outperform when the S&P 500 declines 20% or more. So we're talking about staples, healthcare, talking about utilities. So when times get tough, investors tend to flock to steady defensive areas in the market. And so let's go ahead and zero in and just talk about like three different ETFs, exchange traded funds that tend to outperform when the stock market hits the bear market. So let's talk about the Consumer Staples Select Sector SPDR Fund, right? So this is an ETF. This is basically just an exchange traded fund full of stocks that are available to be purchased individually on platforms like E-Trade, Robinhood, M1 Finance, you name it, right? Now, one of the first ones is the Consumer Staples ETF, ticker symbol XLP. Now, this particular fund is packed with your everyday companies your consumers have grown to love, right? We are talking about your Target, your Walmart, your Coca-Cola, ticker symbol KO, right? And so XLP offers a very attractive forward passive income dividend yield of 2.68%. And like I said, this one actually has the stock Coca-Cola in it, and Coca-Cola pays a 3% dividend. And this one stock this one particular stock in this ETF makes up 10% of it. So it's a big player in there. Healthcare sector SPDR, ticker symbol XLV, right? And so this is the next area that can really thrive during a recession. This is the healthcare space, right? So this is more of like a defensive play in terms of trying to offset the inevitable losses that will probably take place in the stock market. Healthcare is a good spot to be. So this is a ETF, ticker symbol XLV. All right. So the healthcare select SPDR fund, ticker symbol XLV, it offers a forward dividend of 1.68%. It's an easy way to kind of get a broad-based healthcare exposure. Not a bad ETF to be invested in. Probably not one of my personal favorites to kind of go heavy on, but I think it's good to have this one just in terms of diversification of my assets. So I wanted to definitely share that one with you. And the top holding in this particular ETF is pharmaceutical giant Johnson & Johnson, ticker symbol J&J. And this particular company has a very deep history of dividend growth. In fact, if I'm not mistaken, I believe it is one of the dividend aristocrats that we talked about in a previous video. Basically, to become a dividend aristocrat, you have to have consistently paid out your dividends for at least the last 25 years in a row without any type of interruption in your dividend payouts to your shareholders. Now, Johnson & Johnson is actually independently, like let's just say you want to invest in Johnson & Johnson stock. Johnson & Johnson, ticker symbol J&J, actually pays a dividend of 2.77%. So not a bad place to invest money from a defensive standpoint during a recession. And the last ETF I want to talk to you guys about is ticker symbol XLU. I'm going to drop the details on that one in the description down below. Drop a like, subscribe, be safe.